Hello, everyone. Welcome back. Today, we're going to dive deep into the portfolio protection, which is essentially the portfolio quality test. And these are not just boxes to check, they are dynamic, covenant-based protections that ensure the structural integrity of the deal for both equity and debt investors. And we'll cover, key weighted average tests, dive into the critical favorite overlap tests, and outline the various concentration limits that bind the portfolio manager, if you will. Okay, so we did review this in the previous video, but at the heart of the CLO protections, there are these OC and IC coverage tests. Think of them as the primary alarm system. Um, the OC test is a balance sheet test. It ensures that the principal value, not the market value, of the loans backs the notes issued, right? So the IC test is a income statement test. It ensures cash flow is sufficient to pay interest. Each test has a senior and junior version with the specific thresholds that typically step down after the non-call period. A breach triggers something as we call as cash flow diversion, which redirects money that would go to equity and junior notes to instead pay down the most senior notes, first effectively, resetting the leverage and also trading and actively monitoring the portfolio if any types of triggers occur. Here's a little, you know, picture of how the coverage tests are essentially self-healing. We have just the OC threshold and a base case and a stress case. And, if something does occur that, a trigger event does happen, the CLO itself is self-curing and self-healing that there are things that prevent this from happening and also could easily fix, um, as an asset manager, as a CLO manager. Okay, so next let's talk about three key weighted average maintenance tests, right? So first is going to be our WARF, which is our weighted average rating quality. So every loan is mapped to, a number, right? Let's consider it as a credit score. Each loan has a numeric rating, um, where a higher number means a lower rating for, certain depending on what credit agents use, but always the higher number means a worse credit quality, right? So, for example, if a B loan or B less anything less than a B gets a factor of, B minus gets a 3,400, right? Let's say, while a double B might be 1,000. We calculate the par weighted average of these factors across the entire portfolio. The indenture sets a maximum limit, so if the portfolio's WARF creeps above this limit, the manager is in, I guess we could say, violation and must trade to bring it down. That's why I call it self-healing, right? So you have these tests in place that ensure that the portfolio is compliant. If something does go wrong, cash diversion doesn't just happen, right? Um, so this is done by often selling lower rated assets and buying higher rated ones. Um, but we also have to keep in mind that there's other constraints, right? That we can't just buy and sell because one thing's not performing well enough or has a poor credit score, credit rating, right? So this is a quick little picture that I think it speaks to how strong CLOs have performed. That of the nearly 21,000 CLO tranches rated by S&P, only 67 or zero point 0.3 have defaulted. That is quite literally insane, especially in the credit space, especially during the 2008 and a crash, as well as, COVID in 2020, the pandemic, where we had a recession in our economy that even fighting macroeconomic downturns, that CLOs have stayed strong and consistent. All right, so the second weighted average test is WAS, which is the weighted average spread or the weighted average coupon. This is the engine of the CLO's actual cash flow, right? The interest. It calculates the average interest margin the portfolio earns above its actual funding benchmark, which is typically SOFR, right? So SOFR plus 150 bips, right? 1.5%, and so on and so forth. The indenture maintains a minimum loss, right? So this ensures, you know, that the test, let me say this ensures the portfolio is returning value, essentially. It forces a manager to maintain a portfolio with enough yield to cover the no coupons, as well as any type of other like expenses, right? Trustee fees, management fees, etc. And with the residual excess spread, that flows down obviously to equity. So crucially, it's based on the loan's original coupon spread, not its purchase price. So this kind of loan still provides its full contractual spread, which is great because it obviously benefits the weighted average spread. Um, so next, so next we have weighted average life, right? This is the weighted average life till the loans mature, right? So this test manages the structural asset liability mismatch, if you will. CLO notes have long legal finals, maturities, but loans are often refied or called well before the legal maturity, right? Especially when the asset manager is constantly trading assets and buying and selling daily. So the wall test uses a legal final maturity date of each loan to calculate a par weighted average life for the portfolio. The indenture sets a maximum, right? So forcing the manager to avoid portfolio that matures on average too far in the future. Um, this helps ensure the portfolio can be repaid in an orderly fashion to meet the CLO's own liability schedule. And before I move on, all these weighted averages that I mentioned, Wharf, Wall, Loss, it's very easily calculated in Excel just using the sum product. He's taking the sum product of the value of the loans. Um, and then obviously you're going against whatever factor, right? So it's a very simple calculation, but there are a lot of intricacies within the actual formula, right? And here's just a little illustration of wall, within the trading plan. So say before your trade, so a lot of hypotheticals also ran before a trade is actually finalized to see if it is compliant within uh, the portfolio and within the venture, right? So let's say before the trade, the wall was a threshold of 3.5, and we have a wall of 3.75. So if we purchase loan A at 800K maturing in 4 years, our wall is now 3.76, right? But if you're going to take that same scenario, but on top of that, we also buy a loan maturing in 1 year, we're going to lower our wall and get back down to the 3.75, right? So this is done a lot in CLO shops where they're not just going to buy one trade, right? Maturing in 4 years, they're going to buy another one maturing in 3 years, another one maturing in 2 years, whatever it may be. Okay, so let's move on to a more nuanced protection, the bivariate test, right? Bivariate test, excuse me. These are I like to call, I don't know, more like a double jeopardy or an overlap test. The logic is simple, but it's very powerful, right? It's acceptable to have some low rated loans, right? I mean, it's obviously going to help the spread, and it's acceptable to have some long dated or even low spread loans, right? But it's unacceptable to have too many loans that are both low rated and long dated, or both low rated and low spread, right? So these tests create I guess you could say, a two-dimensional box. For example, a venture might say no more than 10% of the portfolio can consist of loans that are rated B minus or lower and have a final maturity longer than 8 years. And the managers, they obviously must constantly monitor these overlap buckets to ensure that the portfolio is overall compliant. Okay, so beyond the weighted averages, the indentures are filled with specific concentration limits. These are not, these are, I guess you could say, these are not the no too much of anything rules, right? You can't have too much here or too little there. The most critical are the obligor concentration tests, which ensure that no single borrower is over, let's say, 1.5 to 2% of the portfolio. And the industry concentration test, which prevents the overexposure to certain sectors like retail or energy, right? Um, that's just an example. And we also have tests like the triple C bucket, right? It's a major focus for investors. It's hard to cap the worst rated assets. You know what I'm saying? So it's like you don't want to have too many of these low rated, right? So it's essentially a cap on how many triple C bonds or loans you could hold. Other common tests include defaulted securities, require minimum percentages of senior secure loans and restrict exposure to certain, areas, EU, certain type of currencies or asset types. These tests collectively enforce diversification, right? It's almost think of it like an S&P, you know, ETF or a mutual fund. They hold ton of different of equities, right? Same kind of concept, but a little bit more restricted on the structured finance side of things. Okay, so finally, let's touch on a few other critical tests. Like I mentioned before, that we have a lot of weighted averages. There are a few other ones that we didn't go into too much detail. So some deals have a weighted average recovery rate minimum, which pushes the manager towards, well-secured loans. So while classic diversity scores tests are a little less common now, the spirit lives on in like complex concentration grids. Maturity date tests are straightforward but vital. They prevent buying a loan that matures after the CLO's own obligations are due, and all of these flow from the foundational eligibility criteria. It's a rule book that defines essentially what assets can go into the portfolio in the first place. So together, this framework creates a very strong playing field, right, for the manager to operate within. It balances opportunity as well as investor protection. So, in summary, CLO quality tests form an interconnected dynamic system of protection. The weighted averages reward for all swall, maintain baseline portfolio stats, and other types of tests, like the buy test or the concentration test, prevent dangerous risk concentrations. And of course, the OCI tests stand as the final forces, redirecting cash flow at the first sign of actual real trouble. And as an investor, your job is just to stay strong, realize these tests are there to protect you, and you know they're obviously non-negotiable. They're in an indenture. They have to be complied, and the manager has to do its job to ensure that its LPs or investors are protected. And of course, tighter threshold means less manager discretion and stronger protection for you as an investor. This framework is what transforms a manager's pool of risky loans into, a structured investment grade security. So that's it for this video, guys. Let me know if you have any questions in the comments or you want me to touch on anything more specific. Happy to do so.